Today's program tackles a subject that many of us don't talk about on a daily basis. We're talking about prescribed assets. Now, let me remind you, we had a conversation about this a few weeks ago where we spoke about these priced assets and the concept and the kind of fear as well that it is generating within the private industry. Well, to get further on and take that story further, I'm joined in our Cape Town studio today by my two guests. Let me introduce them. Andrew Cantor, he is the Chief Investment Officer at Future Growth Asset Management. And Sean Hagedorn, Independent Strategy Advisor, returns to continue the conversation that we had, which included Francois Conradi from NKC Independent Economist. So let's start perhaps with you, Andrew, because you are involved in the subject to a greater degree than perhaps us, because we talk about it, whereas you live it. Let me begin first by getting your understanding as well as your stance on the issue of prescribed assets.
Sure. Thanks, Godfrey. We've been doing developmental investing for nearly 20 years at Future Growth. We do it on a commercial basis. We manage people's pension funds to seek returns and have on-the-ground impact. And we've been doing it successfully, earning sound returns and keeping clients happy for many years. I think this prescribed asset debate is politically charged. I think it's completely an inappropriate discussion. I think it's an inappropriate policy. Pension funds, people's pension funds, yours and mine, are not instruments of state policy. There are many tools the government has to promote development, as they should, as in a developmental state. People's pension funds are part of the savings and investments structure of the economy. They are not a political or policy tool of the government.
Is there a way in which prescribed assets could perhaps be utilized in a way that is focused and does not scare private investors, investment managers such as yourselves?
Probably, but you know, it's not going to go that way. The fact of the matter is that every time the subject comes up and you talk about what is going to be prescribed, it then becomes a whole political football about who wants their certain sector of the economy or certain types of deals to be financed at subsidized rates using people's pension funds. I don't believe it's possible for a clear definition of what is developmental to be arrived at. You know, sometimes just funding a small bank and that services a certain community is developmental. Sometimes building a shopping mall in a previous disadvantaged area is developmental. But nobody's going to count shopping malls at some sort of policy level as developmental. It's fraught with fads. It's fraught with cycles. I mean, nuclear power was a bad guy for many years, then it was a good guy, then it's a bad guy again, and now it's a good guy again. These things are not things you can write into policy that have long lives about definition.
Okay. Sean, let me come to you. You hold a slightly different view because you're looking at it through the lens of perhaps a greater concern around political stability going forward if transformation is not tackled through perhaps policies such as trying to prescribe for which assets private managers can invest in. Is there a good counter argument to what Andrew is saying?
A lot of cons, and there's one overarching pro which possibly trumps all the cons. But just before I get to that, the other reason it's very important to talk about it is, and I'd like to hear Andrew's view on this, I think it's exceedingly likely that some version of prescribed assets is going to happen, and I'm hardly alone on that. So it's quite likely that we're headed in that direction. And so the financial services sector and the broader community should be prepared to engage in that debate. And then to get to your question, in terms of what the one advantage is, and maybe it trumps everything else, and as if prescribed assets isn't contentious enough, what I'm about to say is equally contentious, and that is, has the financial services sector done enough to advance transformation? And I feel very strongly it hasn't. It's very interesting. Andrew is here because he would be very much at the forefront of the organizations that have advanced transformation. But that's a pretty exclusive group.
And we'll talk about what they are doing on that front, because I've got a list of some of the investments that they have made over the years here, and they've got a fund as well, an infrastructure and development bond fund that is 19 billion rand. We'll talk about that. But I want to talk a little bit more about how we can make it work, essentially. I want to try to explore if it's possible to make it actually work while addressing the concerns that people like Andrew are worried about.
The only way I see it working is if the financial services sector, the leaders of the financial services sector, actually, I suppose to put it in a somewhat playful way, is compete more directly in Andrew's space. And in other words, move farther in that direction where, in my opinion, and I'm not alone on this, there's a lot of other people who would feel the same, who are maybe more focused on the political economics in terms of economics, is that the financial services sector has shied away from really focusing on transformation. And I would go well beyond that and say that the financial service sector has created a great deal of damage, mostly around unsecured lending, and that has undone a great deal of the work that other organizations, such as Andrew's, other organizations have done.
Yeah, Andrew, let me come to you. Now, why are you guys so scared about this, given the fact that you already invest in government bonds anyway? The money goes where the government directs it. What would be wrong in coming up with a structure that identifies where the money is going and is managed transparently?
The goal we're discussing is channeling pension fund money into developmental investments.
Yes.
Roads, telecoms, water reticulation, electrification, rural development, job creation. I have no problem with that. This is what we do. This is what and we have a tool for this already, by the way.
Right.
It's called the public capital market. It's called the financial system. And I think it's fallacious and a little bit unfair to say that the financial sector has done nothing. And it's not just future growth. I mean, in the last kind of 36 months, we have seen this financial sector channel something like 193 billion rand, that's a big number, into the alternative energy sector. These are well-structured deals, commercially financed, commercially run, on risk, with an element of government support and framework in the form of a power purchase agreement. Vitally necessary. The point is money's available. There's never been a shortage of money in South Africa for developmental investing. I've never seen a time when a good, well-structured, intelligently put together developmental plan could not be financed. What the government wants to do, and I want to be very clear on this, is the agenda is to get subsidy finance with people's pension funds. It runs completely counter to the goal of getting people to save for retirement and get them off the fiscus's responsibility. It runs against tax policy in terms of pension funds, and it certainly messes with public capital markets, one of South Africa's great strengths.
Yeah. Now, some people are arguing that by directing this money into a structured, it could be fund, it could be however the government comes up with it. By doing so, you are actually targeting very specific areas. And are you saying that this is wrong, or this will not be properly managed? Would it be acceptable if, say, for instance, it were privately managed?
I just don't believe it's possible. I have seen no evidence that the government or any sector of government is able to rationally decide what an investor should do. And frankly, it's like some government body saying, you know, I don't really like Pick and Pay. You can only shop at ShopRite, or whatever. It's a crazy thing to even suggest. It is not the way. South Africa has an incredibly sophisticated banking system, a savings system, a pension system, and a unit trust system, and it works in an integrated way very effectively. And things get financed. You know, look at to say that funds have done nothing is not true. We've got in our funds about 20 billion rand or 19 billion rand now, over 100 different pension fund investors, many who have been there since the 1990s. The banks channel enormous amounts of capital. I know there's a shortage of good transactions because there's competition for deals out there. It's not like there's too many deals chasing not enough money. It's the opposite. Prescription is a dumb solution because it doesn't address the issue of skills on the ground to put together and manage projects that get things to happen. That's the job of government. They must do their job and let us do our job.
Yeah. Sean, what do you say to that?
It's very interesting that Andrew's here, because I would put Andrew as one of the top two guys who's been forward in addressing a lot of these issues. And I'm going to quote Andrew, and it gets even more ironic because he and I made exactly the same quote. It's with reference to unsecured lending when African Bank was in a lot of trouble just over a year ago. And we both said that they were impoverishing their customer base. And a great deal of that has happened, where most households in South Africa today are either poor or they're overly indebted, or both.
Yeah.
And the big reality is transformation isn't working. And there are a lot of successful efforts, but for the financial services sector in general, net has not contributed very much. And the one argument in favor of prescribed assets isn't that, I agree with so much of what Andrew's saying. It's not that government knows how to direct these things, but hopefully the financial services, the leaders of the financial services industry would come forth and actively engage with government. And basically you would have a much more engaged and constructive conversation, where at the moment, and kind of like what Andrew's point is, saying that the financial services, capital markets, and the bank system performs its functions,
Yeah.
you couldn't really go in front of a political rally and make that point. There's just too many hungry people out there.
Right, right. But the point he's also making is that it's not about money, because the money is available. It's how you use the money. And he's also talking about another key issue, which is the lack of skills to be able to do the deals that would be required to get this going. Now, what are you saying about that?
Look, economic development is very tricky. I mean, if you want to take a moment, I can give you some examples of some of the most esteemed players in the global financial markets and in government around the world have stumbled very badly in recent years, and some of the top academics. Economic development is very difficult, but South Africa's circumstances are particularly extreme. When we think about South Africa on a per capita basis, probably has the most mineral wealth. When we think about it, probably has the most unemployment. And if you look at the slowdown in China and the implications for a lot of people talk about the new normal, the trajectory going forward is very scary. So my big point is that the financial services sector leaders need to engage much more actively than they have, and if the only way to get them to do that is prescribed assets, I'm in favor of it. If they could engage more actively without prescribed assets, that would be better.
Yeah.
But we're 21 years into this.
Okay, I'll get to Andrew to try to understand what the private sector, the private financial industry is doing about that when we come back on the other side of the break. We are talking about prescribed assets, the suggestion that the government could ask private money managers to put a certain percentage of their money aside, and that money be used for developmental purposes. Talking about prescribed assets in South Africa. My guest in Cape Town, Andrew Kanter, Chief Investment Officer at Future Growth Asset Management, and Sean Hagedorn is an independent strategy advisor. Sean, let's begin by talking about two of the issues that Andrew is concerned about and that we have also discussed previously. There's the issue of the perceived higher risk by having government direct certain chunks of money into certain assets. And then secondly, there's also the issue of the suggestion that there could be lower returns. Now, when we look back at history, we've got two countries in Southern Africa that have gone this route, and in both cases, it has come back badly. Zimbabwe had the same situation, and then we know what happened to people's pensions in Zimbabwe. And then here in South Africa, under apartheid, we also had the same situation where 77% at some stage was directed into these very structured and government-directed entities. Now, when you look at those two issues, are there answers to those that could help perhaps assuage the fears of private managers like Andrew?
There are investments being made in economic development projects, and that's going to continue to happen, and in large numbers. What is lacking is, I mean, no one's really coming forth and saying that they have a full employment investment thesis. The reality is South Africa now is looking at what's a worst case scenario, which is prolonged stagnation. And I think what a lot of people don't understand is prolonged stagnation is much worse than a crisis. You know, if you have a crisis, then people are forced to come together and make difficult decisions. You look at the U.S. economy now, for instance, so they had the subprime crisis, and the U.S. economy made necessary structural shifts. In Europe, you also had that, perhaps to a lesser degree. South Africa never had that, and if we look at why they didn't have that in part because there was a number of things happened, but a big part of it was that China responded to the slowdown, the global slowdown, by having a big increase in fixed asset investments, which helped the South African economy.
Right.
And so now that's coming off, and we're beginning to see what really are the long-term trends. And South Africa's economy, when people talk about things like the new normal and the big shifts, which really are happening now, and that's why you're seeing the volatility in the capital markets, South Africa's economy is very poorly positioned for that. So the financial services sector really should come together with government and come up with structural shifts.
Yeah, so Sean, what are you saying? So are you saying that the possibility of lower returns is necessary pain for the longer term gain?
You talk about lower returns. See now here's where there's a big distinction to be made between the core economy and sort of capital markets and pension funds. What you really want to do is protect the core economy, where South Africa is really different than in so many ways it's really different. But you have what I keep referring to as a poverty trap instead of a debt trap.
Yeah.
And you could also see that in a lot of it, there's some technical reasons. It's like if you lend, like a subprime crisis was lent against assets, so you can have an asset bubble, and that's self-correcting. You have a lot of things going on in the South African economy which haven't been self-correcting. In effect, it's gone the other way, where there's been global crises, and South Africa has carried through without addressing the core structural shifts. So I don't think it's really right to focus on the return so much. However, if the core economy, if things stay as they are, you're looking at prolonged stagnation, which could lead to political upheaval, contractions. It doesn't need to be that way. I'm one of the most optimistic people going forward, but you have to have profound structural shifts. And government isn't going to do it on their own. And quite frankly, the financial services sector could have done a lot more to have gotten up to speed on the state of art of economic development, and they don't score very well in that. And the proof of that is a year ago is the whole African bank debacle and how that was handled, which was all wrong.
Yeah, Andrew, if I'm understanding Sean correctly, he's saying you guys perhaps the focus on returns is perhaps a little misguided because there's a bigger danger that's looming and you are unable to see it. And perhaps to buttress that argument, you say yourselves the industry has invested over 193 billion rand into developmental type investments. Now, if you have invested such a large amount of money and we're still in the quagmire that we are in, wouldn't then the suggestion be that perhaps we need to perhaps put a structured vehicle that directly addresses some of the capacity issues that we know are bedeviling the economy and preventing it from growing faster?
So there's several threads there.
Yeah.
The 193 billion was related directly to the alternative energy industry, the wind and solar industry we've rolled out in the last 3 years in this country. It's an enormous number. There's a lot of complex projects, very well done, world-class work done on that. The second point I'd like to make is I fully agree with Sean about the unsecured lending industry, but it only proves part of my point. There was a period in South Africa when the major banks would not lend to low-income consumers. You needed an alternative lending industry, and we were big supporters of that in the early days until they all went haywire with share options and getting rich and stuffing debt down consumers' throats. The point is it was a fad, it was a trend. It's not something you could define as developmental on a permanent basis. Important thing about investment management is to be able to understand when the trends change. Your point and Sean's point about giving up some returns, compromising on returns in favor of developmental impact, it is not the job of the investment industry, and it is certainly not the job of pension funds. The government itself is 30% of the economy. It is their job to govern the economy towards a growth. I don't disagree with Sean's assertion about the need and about the need for delivery and about focus, but it is not the role of pension funds as the primary driver of that. You cannot take on a fiduciary duty for the nation as a pension fund. You can only take on a fiduciary duty to your members. So there can be no compromise of return in favor of development. There can only be a compromise of return in favor of risk. That's how the machine works, and it's a powerful and useful machine, and it does work now. I've already said there's never been a shortage of money for any good, well-structured deal. There's a shortage of skills. We could have thrown billions and billions into municipalities years ago, but they couldn't deploy the money in houses and local roads and local electricity. They just couldn't do it. So we buy government bonds. The point is, prescription is a way to channel money and force money in at a subsidized rate. And I challenge you, Godfrey, if I tell you that I'm going to use your pension fund and give up your returns in favor of giving away money for development, are you going to keep saving for retirement?
I might, if that's going to benefit my future and the future of my children, and they can secure that future.
Well, that's very generous spirited of you, but I can firmly assert that that is not the way it will work in practice. People will stop saving for their retirement because they will see the government as being a land grab on their money, and our savings industry will collapse, and that will be a disaster for the entire economy, and that will be adverse to development in this country. It is simply not the job of pension funds to offer subsidized yields. We have well-capitalized development finance institutions like the DBSA and the IDC, National Housing Finance Corporation. I go on and on. A lot of money to spend, a lot of skills on the ground, ability to do subsidy and risk capital, with the government to support them with policy and enabling environment. That's their job. Our job is to work with them. To go after people's pension funds is an unmitigated mistake. And I want to make one more point. Sean asserts strongly he thinks it's going to happen. Bull. It will not happen. It will not happen in this country.
I actually wanted to challenge Sean on that, and I wanted to ask if, Sean, do you have it, shall we put it, on authority that this is going to happen?
No, I wouldn't say it that way, but I mean, I have tested it with people in Parliament. I mean, not any sort of large scientific survey. But just to come back to Andrew's point, if I may, I mean, there is a big gap between what Andrew's saying and what I'm saying. the big point is the government policies. I mean, Andrew can do everything right and his returns still be lousy because of government policies and without prescribed assets. Okay, if the rand goes, it just continues to lose value. Doing something at CPI plus 4 or 6 or whatever, if the rand is losing 20% a year compounded, and then you get political upheaval and the like. And so what I'm saying is just trying to make a finer point of it, where there's a difference between Andrew and I'm saying that the leaders in the financial services sector have to figure out a way to get across to government. And he doesn't really see this as his job, and I respect that, but I respectfully disagree, because now we're at a point where the wheels are coming off, or there's certainly that threat that the lug nuts, so to speak, are now paper thin, and it's not business as usual.
Yeah, but Sean, are there other countries in the world where perhaps we can point at successful implementation of prescribed assets that have made a difference? Because I read an article the other day from Vincent Musewe, I think he's a Zimbabwean, but who lives now in Johannesburg, and he was talking about the fact that if the money is directed in the right assets and is invested in future productive capacity, or invested in assets that build the future productive capacity of the economy, then it is making a difference that then ensures the success of the scheme.
Well, in terms of other countries, I really don't like going down that path, because people should sit back and look at just how unusual South Africa's circumstances are in general, but particularly right now as China is starting to slow, and the effect on the commodities market, the new language around stranded assets, and the new normal. These are some of the leading business people and the leading economists in the world are talking about that. So, and then the other point about back to returns, again, the returns are only going to be attractive if the economy is functioning effectively. And there are terrible policy ideas that run very deep, and they have to be corrected, and they have to be corrected soon. Otherwise, to fall back on being clever investors, you can be very clever investors and do things exceptionally well, and still your returns aren't going to be there.
Okay. Andrew, if I can come to you now, you have been involved in this industry for a very long time, and you also, as future growth asset managers, are invested in these developmental type investments. What advice would you give the government to try and get this right without destabilizing the industry, while of course creating a future that enables you, as Sean is pointing out, to be able to get the returns that you are capable of in a functioning economy?
I think the National Development Plan was very, very rational and forthright about what was needed in the country. It gives a clear directive to each ministry of government about what needs to be done and how and what the goals are. And I think each of the tenets of the National Development Plan fit very easily into funding structures with development finance money, with government money, with private money, coupled with appropriate skills. You can fund all the development you need. That's how government should focus. Less on basically trying to steal people's pensions, and more on actually focus on how they run their affairs and make things happen from an organizational view as government. I must say, if we are going to discuss prescription or the threat of using private pension funds, I really don't see why you don't start with the government pension funds. The government employees pension fund is a defined benefit scheme anyway. It's over R1 trillion. I mean, heck, throw in the Eskom Pension and Provident Fund, which is probably also a defined benefit, or Transnet and all the whole gang. You've probably got R2 trillion of assets. If you really want to use pension funds as part of your developmental state or state policy, use your own money. Don't undermine the savings culture and savings initiative of the rest of the economy.
Would you be assured if this money were managed by the PIC?
Absolutely not. No, of course not. To say that we all have to give money to the PIC and they're going to manage it on a developmental agenda, they've got R1 trillion to manage. They're struggling to do that. And to say that somebody's pension fund, you're going to force them to put it with a particular manager, is the same as saying I'm going to force you to use ShopRite instead of Pick and Pay, or BP instead of Shell. That is not how an economy functions.
Absolutely. We have to leave it there, gentlemen. Thanks very much indeed for your time. I've been speaking to Andrew Cantor, CIO at Future Growth Asset Management, and Sean Haggadon, Independent Strategy Advisor. They were both in Cape Town, and we're talking about this very hot topic around prescribed assets.